If you're in a position where you earn over 100,000 through bonus, through various other incomes, because you're in a high-powered job, wherever you might be, as you go over that £100,000, for every £2 you're over the £100,000, you lose £1 of your personal allowance. That's 12,500, which is why this number is critical. So if you are anywhere near that figure, please do reach out to us or whoever it might be and get some advice, because effectively you end up paying what I call super tax, because by losing the personal allowance, it effectively becomes a 60% tax rate on that difference in between. So what can you do? Top tips: if you're over 100,000, you should. If you're over 50,000, reduce your income as well, but that's nothing to do with the personal allowance. We'll come on to that in a second. If you're over 100,000, look at other ways you can legitimately reduce your income through pension, through charity contributions and various things. Again, seek some advice. But make sure you're using all your allowances, and obviously the personal allowance, make sure it's right, especially once you get to that level. But be aware of the married couples allowance. So at the end of today, you're going to get a chance to download a tax checklist. The married couples allowance is in there, but I think we've managed to capture 30 or 40 of the different things to consider in a checklist, which you'll get at the end of today. But the married couples allowance is massively underused. We put it in the wealth management update at least twice a tax year to remind people you've just got to check, is you or your spouse not earning 12,500? Is the other one over 12,500? You can transfer 10% across, and if you haven't done that yet, you can do it for the next, you can go back 4 tax years as well and claim that back. So win-win. Obviously only if you're married, but this is all to do with the government over the years. Many governments trying to encourage the family unit and various things. All right, this is why same-sex couples have fought so hard to have the same treatment as married couples for little things like this. Okay, so capital gains tax, bit of a boring one, but weirdly enough, capital gains tax is taxed less than income tax, which is a strange one. So the annual individual allowance is 12,300 this tax year. If you've got assets in a trust, you only get half of that allowance, that's £6,150. If you're a basic rate taxpayer and you sell an invested asset that's made some money, it's 10% tax. But as we know, the government don't like property entrepreneurs, landlords, whatever it might be. So if you're a property owner, you pay 18%. And then if you're a high rate taxpayer, it's 20% on traditional gains, 28% on property. Now, I believe with capital gains tax, you should never really pay it if you can. I mean, why wouldn't you? If you've got an asset that's gone up by, let's say, £50,000, unless you really need the cash, it's almost like a tax deferred loan, and you get the compounding effect as that 50,000 has made you 50,000. You don't pay the tax. If you only pay the tax if you take it out, why wouldn't you leave it in there and let it keep compounding? Use the government's money, and Einstein said that it was the 8th wonder of the world was compounding. Those who don't understand it pay it. Those who understand it make it. And this is a classic example of that. Leave your gain in there unless you have to sell for personal financial reasons. Leave the gain in there or do something else, so that you never pay this tax and you're getting the return on the return on the return. So that's the basics of capital gains tax. I suspect that'll change in the next budget. So you might find we do one of these in 3 weeks' time, depending on any significant changes that are in the budget. You might leave everything alone this time because of where we are, but we shall see. The capital gains tax is a use it or lose it allowance. If you don't crystallize in a given tax year, you don't get to come back to this. So if you make a gain of 50,000, you cash in next tax year, you've lost this year's allowance, you can't carry it forward. If you have got something in your portfolio, if you have been doing any self-trading, or you've got some shares you inherited, or you've got a property that's lost value for whatever reason, don't be afraid to crystallize that loss. Sell the asset, crystallize that loss, because you can carry that loss forward against future gains if you're in that position. So if you've got, let's say you bought some, I hope you haven't, I really do hope you haven't, but if you've bought Bitcoin and it's gone down, might be a good time to sell it, to crystallize that loss, then repurchase. So you can, a couple of days, a week or two later, or buy something else, then you can offset that loss against the future gains. We don't get to do much planning in this space because most of our clients are leaving it long term, but every so often we might tell you to cash in some of your non-ISA money just to crystallize a loss and then do it a different way. If you are going to crystallize a gain, reduce your income where you can. So find a way to reduce the income to take you from that 51,000 a year income down to 49,000 a year income, because then you'll pay capital gains tax at the lower rate on at least some of the gain. So that's some clever planning you can do in advance. And if you do have the privilege of being married, you can potentially transfer some of the asset, half of the asset, to your spouse and use 2 allowances. So well worth considering. Actually, I'm not sure if you meant to, but I can now see your face. Okay, he's gone again. Okay, right. So capital gains tax in a nutshell. There's some things you can do there. So income tax. So hopefully you all know the basic rate is 20% between 12,500 and 50,000. 40% from 50,000 up to 150 with the personal allowance in the middle, and anything above 150 you pay 45% on. So actions when it comes to income tax are, where you can, reduce or you defer your income. If you're in a small business, if it's your business, obviously don't take too much income out in the one tax year. You can obviously defer into other tax years. There's different things you can do there. But where possible, switch your income to a pension. It's interesting having a chat with my stepson last week. He thinks this year he's taken on a new job through lockdown because scaffolding has gone nuts. As more construction work seems to be going on. They were obviously one of the first out of furlough and stuff. And next year he didn't work a full year this year, he only took the new opportunity in the summer. He's worked up next year, he's going to be a higher taxpayer. He actually said to me, I don't want to pay 40% tax. I'm going to put everything above 50,000 into a pension. Can I do that? I was surprised. He's obviously been listening to me over the years, and yes, you can. So, if your income is at the high end, or even if you're earning 30,000 and you're only spending 20,000, there's merit in putting some of that extra 10,000 into pension, because anytime you put money into a pension, it's a 25% 25% return through tax route. If you're a higher rate taxpayer, it's 66% return. If I mentioned those numbers to you and I didn't put the word pension in front of you, you'd snap my arm off. Give me 800 quid and it's worth 1,000. Give me 600 quid and it's worth 1,000. If I don't mention the word pension, I'm sure everyone would happily do that. But when it comes to pension, that word goes in front of you, people suddenly get put off. And as long as you don't do something stupid with your pension, it's a great place to be. And share your income where possible. If you've got a limited company, put a spouse on it. If you're a sole trader, become partnership and bring your spouse into the business. Just do some admin or something, but use the allowance. If your employer is generous enough to do it, if they're a small business, they might be able to let you have some of your income diverted to a spouse. Might need to be a compromise in terms of cost for them around national insurance and stuff, but certainly where you can share your income. But a great idea that not enough people take advantage of is, for those of you who've got kids at university age, approaching or in university now, you're probably paying for some digs, you're probably giving them some money to live the student life, although it's not great right now. Why wouldn't you give them a job in your business? If you're a sole trader, a partnership, LLP, limited company, why wouldn't you give them a job? I'm sure you can find a database to cleanse, some scanning to do, some copying to do. Why wouldn't you pay them so that you've got money coming out of the business or out of your profit to them using their personal allowance? So rather than giving them money out of net income, because many of us, sort of like this above and below the line thinking, and many of us think we can only plan below the line. Where possible, we want to plan above the line. So where you can, share your income with the spouse or the kids, as long as you're comfortable doing that. You don't have to pay them the full 12,500, but if you're giving them £500 a month anyway, why wouldn't you give them 6,000 of it as income spread over the months, and then get them doing some work for you, around evenings and weekends and whatever it might be. The other thing you do is, if you've got kids in private education, if you're a limited company, well, actually I'll leave that because I've got a whole slide for limited company owners a little bit later on. Okay, so inheritance tax. Now, I've got to be careful here because most of you have met me, seen me speak about inheritance taxes or joined our webinars and seminars over the years, our education program. I can talk about this subject all day, so I'm going to try and keep this brief. Anything above £325,000 pays 40%. If you think about you as an individual, forget the married couples for now, you as an individual, and if you're a married couple, you can potentially get 2 of these allowances. If you've got assets above 325, you can also have an additional inheritance tax-free allowance of £175,000, assuming you've got a home worth the right value. But once your estate gets above 2 million, for every £2 you go above 2 million, £1 comes off the £175,000 allowance. So quick story, I was with a couple not so long ago, and they said, oh, we think we've got £1 million inheritance tax allowance. Okay, I looked to their position, and actually I had to tell them that they haven't got £1 million, they actually only got £850,000.